Hi everyone, my name is Sarah, and today I'm going to be talking to you about HSAs, 401ks, and IRAs. But before we get started, I wanted to tell you a little bit about myself and my qualifications. I have a bachelor's degree in finance from the University of Findlay and a minor in business administration. I've also tutored in finance, accounting, and economics, as well as worked briefly as a finance manager at a nonprofit organization. I'm also certified in investment fundamentals, financial performance, principles of economics, and accounting principles through the International Business Management Institute out of Berlin, Germany. So let's go ahead and get started. What is one thing that all of these accounts have in common? HSAs, 401ks, and IRAs are all tax-advantaged retirement accounts. The most common tax-advantaged retirement account that people have heard of is the 401k. The 401k is offered by your workplace, and there are two types, Roth and traditional. The traditional 401k involves contributions before tax and can reduce your taxable income for the year. In other words, it can allow you to move into a lower tax bracket if you're on that borderline. A Roth 401k, on the other hand, is an after-tax contribution, which means that you'll never need to pay taxes on those withdrawals. Let's talk about why you would use a Roth 401k over a traditional 401k. Let's say that you're at the start of your career. Because you're at the start, you'll likely have a lower wage and are paying less in taxes now than you will in retirement. With a traditional 401k, on the other hand, this is beneficial when you have a much higher salary because it'll reduce your taxable income. You're also likely paying more in taxes now than you will during retirement. Now let's talk about how much you can contribute to your 401k. The Iras actually just raised the maximum contributions from $19,500 in 2021 to $20,500 in 2022. In many cases, you can also receive a company match, which is typically between 3 to 4%, though this is workplace specific. Now let's move on to IRAs. An IRA stands for an individual retirement account. Like 401ks, IRAs offer both a traditional and Roth option. While companies often offer limited investment options for 401ks, you have much more investment options with IRAs because you can choose who you want to invest through. For example, I have my personal IRA through TD Ameritrade and have access to nearly 13,000 mutual funds as a result. What is the maximum contribution for an IRA? It is $6,000. And lastly, we have HSAs. HSAs stand for a health savings account. A health savings account can help people with high deductible health insurance plans to cover their out-of-pocket costs. These contributions are pre-tax and can reduce your taxable income. Any unspent money in an HSA rolls over at the end of the year, so it is available for future health expenses. Any withdrawals are tax-free if used for qualifying medical expenses. Now let's say you've accumulated all this money in your HSA and think you're never going to use it. Guess what? After age 65, your HSA now acts as an IRA, and you can withdraw money from it just like you would with a traditional IRA. This income will be taxed at the time of withdrawal. The maximum contribution in 2021 for an HSA is $3,600 for individuals and $7,200 for families. They also allow an additional $1,000 per year to catch up for anyone aged 55 and older by the end of the tax year. For 2022, this limit will rise to $3,650 for individuals and $7,300 for families. Hi everyone, I just wanted to say thank you for watching my video. If you liked what you saw, please feel free to check out my website at www.sarahborgelt@weebly.com. Thank you for taking the time to watch, and I look forward to hearing your comments.